capital, current assets. Current assets. So if somebody's talking to you about working capital, generally speaking, think of it as current assets, or think of current assets as your working capital. Net working capital is current assets minus current liabilities. Well, think about that. Isn't that interesting? Things that are going to turn into cash minus things that have to get paid out of cash. Okay, so I'd like my current assets to be greater than my current liabilities most of the time. That would be a good thing. Good thing. And in general, companies that have a high net working capital will be more successful since they can expand and improve their operations. Companies with low net working capital, they lack the funds necessary for growth. There's a term that we have in our personal lives. What do we call it? I'm living hand to mouth. Hand to mouth, which means that pretty much the money that comes into the household gets kind of paid out too, and I don't have a very low net working capital, right? Things that turn into cash kind of have to get paid out in cash. So low net working capital. And that's not we don't like living in those situations. Even though we have to sometimes, we don't like it. Businesses is not a good place to live either. So I just wanted to touch on that term because it relates to the categories of the balance sheet. And a word about book value and market value. We've kind of talked about this already. Book value is what the accounting system says, following the accounting rules, says the value of an asset is worth. $10,000 truck, 5 years later, has a book value of 0. There's really no relationship between book value and accounting value and market value. The market value is what someone will pay you for that item in an arm's length transaction. That's market value. Okay, so just got to get those two terms. And just because we have a book value of 0 doesn't mean it's 0. Doesn't mean it's 0. It has market value, but it has an accounting value of 0. Okay, statement of cash flows. Let's chug through those. And things come in threes. You know, the balance sheet has 3 sections, and the statement of cash flows has 3 sections. Threes. There's a theme going here. Okay, now, here's the deal to get on this. Up until, in that income statement, we were talking about profit. Forget about profit now when we talked about the statement of cash flows and just think cash. And remember in the beginning we talked about this crazy difference between accrual and cash accounting, and oh my goodness, I count it as a sale, but I don't have the money. Right now we're talking about cash. Just when it happens, good old U.S. currency cash. So, we have 3 different types of sources of cash. We look at a cash flow statement, you'll see 3 sources of cash. And we'll define this in a moment. Well, let's find out. Operating cash. Okay, it could be cash coming in or cash going out. Oh, by the way, when you look at a statement of cash flows, you'll see positive numbers and you'll see negative numbers. You'll see numbers that have parentheses around them, negative, and then you'll see positive numbers. Anytime you see a positive number, visualize cash coming into the building. And just see it come walking through the door. That's the way I like to remember it. And anytime you see a negative number, visualize cash going out the door. Negative means going out, positive means walking in. Okay? Easy way to remember. So, we've got money coming in, we've got money going out in 3 categories in each of these 2. Operating cash. Okay, what's operating cash? It's the money that has come into the building, if it's inflow, income. It's the money that's come in through the course of what I do. It's probably customers paying me. That's the source, customers paying me. It has to do with what I'm in business for. Operating cash flow going out, dispersing, is usually paying the bills for what we do, paying the lights and the heat and the electric and the steel and the wood and the salaries and the benefits and all the stuff associated with what we do. That's operating. Investment. Now you can't, the way I like to think about investment here is don't think about like investments like your stock market investments, although it could be, and that's not the way to think about it. Think about it, I'm investing in those assets, those physical long-term assets generally that are on the balance sheet. So trucks, machines, land, things like that. So what would be a positive, what would be cash in on an investment? Well, it could be that I sold an old truck, and somebody on Craigslist paid me for it. I got cash coming in from an investment. What would be cash going out? Oh, I bought a new truck. Cash went out. Okay? And then the last one is financing. Okay? So I've got money coming in, money going out, all in this category called financing, and that's one of two things. I've got loan, I get a loan from my bank, and all of a sudden on the day I get the loan, whoosh, it's in my checking account. And that's cash coming in from a loan, that's financing. Or I as an owner, take personal money and I invest it in my business. I give it to my business, or an investor invests in my business. And that would be cash coming in from financing. What if I pay my bank back? Pay them the principal back. You know, make my principal payment, my monthly principal payment. That's cash going out for financing. Or if I give the owners some money back in a distribution, cash going out for financing. So there's two directions. There's cash in, there's cash out, and there's operating, investment, and financing. Let's just take a look at this example. Okay, we're going to take a look at this example. Statement of is missing here, but you get the substance of it here. Okay, here's operating activities. Okay, so the top one is operating activities. The middle one here is investing. The bottom one here is financing. Okay, and what you see is positive numbers and negative numbers. So these are made-up numbers, but let's just imagine what they could be. So I got cash flow from operating activities, cash received from customers, $180,000. Money is a positive number. Money coming in, that would make sense. Money coming from my customers comes into my building. Okay? Cash paid for merchandise, cash paid for wages and other operating expenses. They're negative numbers and they're going out. That tells me, well, that would make sense. Money leaves my building when I payroll or when I pay my suppliers. Okay? Paid some taxes, money going out. And if I just add these up, if I add, you know, I 180 minus 80, almost 88, minus 67, minus almost 9, is a positive number, 16,149. That means in the course of my business thumbs up. In the course of my business operations, more money came in than went out. Okay, does that mean I'm a winner? Well, next week or next month, it might be the opposite. Just the timing of things works out, but that's what it is. That's what it is. That's a good thing. Now, you know, if it were negative 1 month, you know, do I, you know, get ready to jump off the bridge? Of course not. But what if I'm watching it month after month after month and it's negative and it's negative and it's negative and it's negative? And you don't live in Door County where your store is shut down for the winter. Maybe this is your busy season and it's still negative, negative, negative. Would I be concerned? Yeah, I would be concerned. Because if my business can't positively cash flow itself in the good times, how's it going to do it in the bad times? I've got something to watch. That doesn't mean that I don't have a viable business model. It doesn't mean that I'm going out of business. It just means that I've got to pay attention to this and think of what I'm going to do about it. Okay? That's why you want to look at these periodically. Cash flow from investing. Well, what do we have there? Cash received from the sale of capital assets, $3,500. So money came in, $3,500. Cash paid for the purchase of capital assets. It's a negative number, so money went out. Now I had $3,500 come in, I had $15,000 go out, so actually in that category, more went out than came in. I don't know what it is. Okay? I just know that I had that exchange. And if this were your business, you want to know, you'd have to drill down deeper and say, well, what was that $15,000 or what was that $3,500? You know, you might do that on some things. Down here, cash flow from financing. Wow, look at cash received from long-term borrowing, $15,000. So that would be, I probably went to the bank, I got a loan, and when the cash hit my checking account, boom, $15,000 cash in, got it? Okay. Cash paid to retire long-term debt, $1,000. Ooh, that would be like making a payment back to the bank, $1,000. Cash paid for dividends, that would be money going out to the owners. The owners, a check to the owners. Now, I just like to look at these and say, well, isn't this interesting? That in my little example, what if I had an old truck and replaced it with a new truck? I don't know what's going on here, but I sold my old truck on Craigslist for $3,500. I bought my new truck for $15,000. This was the check I wrote to the dealership. It's money going out. Here's money coming in from my bank, a loan for $15,000. I bet I took out a loan for $15,000 to write the check to the dealer, and here's the money that the guy who bought my truck paid me. Okay, see how that stuff kind of works? See how it fits together? And of course down here, just in this category, we had 9,000 more come in than went out. And then if I take all of these together, this one, and this one, I actually had $13,000 more come in than went out. Now you can look at this over a month. You can say, how do we do over the course of the month? And you look at multiple months to look for those trends. If you look at it at the end of the year, it's kind of a really nice one to look at once. Well, you want to look at it more than once a year. But if you look at it at the end of the year, it's kind of a snapshot back of the whole year. Wow, where did the money come from? Because what if, let's say this was negative month after month after month after month, it was negative. Okay? Doesn't mean I'm out of business. I may have been feeding it. I, as the owner, may just be putting money in, money in, money in, money in. And you'd see that there. Okay, cool thing. Any questions about that? I just got a couple slides left. Oh, this is an important one. Cash doesn't equal profit. Just, it's a good thing to remember all the time. Cash doesn't equal profit. Cash is tangible. I could take cash and turn it into wood and metal and dresses and food and whatever else I need. It has a value. It's marketable. Profit is just a number. Okay? It exists on paper. It's influenced by those non-cash items. Profit is determined by is influenced by depreciation and amortization. It's not marketable. I can't trade profit. I can't bargain profit. I can't write a check for profit. I can only write a check for currency, U.S. currency. So I like profit is an opinion, cash is a fact. Okay? Now, profit represents the value that a customer places on your product that is above and beyond what it costs you to make it. So that's a really important thing to concentrate on, is it represents the value. We create value in our business, and it's represented in a term called profit. Okay? Cash we manage. Okay, I have just a couple slides I want to say about this, about ratios, because they're important. If you're going to look at your financial statements, you need to compare them. How do you compare them? Well, how do I compare last year's gross profit to this year's gross profit when my sales were different? Well, this is the only time. By the way, if you notice on those first three financial statements, we didn't use anything more than addition and subtraction, right? Addition and subtraction, we can all do that. And now you got to do like a little division, that's it. So this is stuff we get. Okay, the next one, method for determining the overall financial condition of your business, the calculation. It's the comparison of ratios which are derived from the company's financials. Helps you spot patterns, and the level and historical trends are what are really important. So this is, how do we do this winter compared to last winter when our sales are different? How is my food cost this year as a percent of my sales different than my food cost as a percent of sales last year? Things like that. It enables me to compare different periods when the performance was different. And sometimes you can actually get industry data. How am I doing compared to my industry? That's a good thing to know. Good thing to know. But almost more importantly is, how am I doing compared to myself? Am I getting better? If I compare myself to last month or last quarter or last year, have I gotten better? Am I the same, or have I maybe slid backwards? Really important. So, if you're going to watch your financial statements, watch your ratios. Profitability ratios, gross profit margin, net profit margin, we talked about those, in there. We're pretty much accustomed to watching profit margins. If you think, what is a profit margin? It's a division problem. It's the profit divided by the sales. Okay? Liquidity ratios and leverage ratios, I don't want to say really much about that, but remember this one we talked about here, current assets and current liabilities. It's a kind of a good thing to watch. Sometimes my current liabilities will be greater than my current assets, but if that's happening too often, I may be getting into a position where I'm not going to be able to pay my bills after a while because I owe more people things in the next 12 months than I expect to get from people in 12 months. So, these are things that you want to watch because they speak to the strength, the health. This is like the doctor taking your pulse, taking your respiration, taking your temperature. You want to watch those leverage ratios. This is, we see this in personal families. Remember, it's that mortgage thing. It's how much debt do I have and how much do I get to count myself? It's my 80-20, and the more debt we have, the riskier situations become for us personally, don't they? We have a lot of debt, not much equity. I lose my job. Ooh, boy, I better get a job real quick because I don't know how to make my payments. If I have a small amount of debt, I lose my job, it hurts, but I can probably still make my payments. So, same thing in business. And then you could watch accounts receivable. How quickly do I collect my money? How quickly do I pay my money? How quickly do I use my inventory? How much inventory do I have? Those are all places where money gets stored. You know, U.S. currency gets turned into IOUs. U.S. currency gets turned into wood because I got a good deal on a train car load of 2x4s. Well, that's great that I got a good deal, but how do I pay my bills if I took currency and turned it into wood? And that's it.